Well, hello, everyone. It is Don Garman here from Mirador Capital Partners. Here we are on March 16th. And obviously, we just rounded the 1 year anniversary from the official lockdown of last year's pandemic. And I think the mood obviously has changed decidedly. And I know many people have their first and some people their second shots. And everyone seems to be feeling a little more optimistic about the next year relative to seeing family and friends and maybe some travel. I certainly see evidence that the roads are getting back to some more trafficked state. So I have mixed feelings about that, but mostly positive because we all are ready to get back to whatever life is going to be. I thought it was interesting. My son, who is a sophomore in high school, went back on the first day he was invited to go back, and there were 3 kids in his classroom. So I would say, judging from that alone, that the pace back to normal will be slow or could be slower than some expect. So I would say this, which is a year ago today, the market was down 3,000 points, one of the largest, certainly, point drops ever. And it was a cascade of uncertainty and fear. And so we would have to give credit to a quick, or call it swift, response by the Fed. And obviously, we have gotten through a lot of uncertainty in the last year. And all due credit to the people responsible for producing a vaccine in a record time. And hopefully, we're starting to get into accelerating the deployment of the vaccine so that everybody has access, as I think the current projection is by the end of May. So that's good news. And I would certainly say that a year ago, if we had all circled, if we had to guess the value of our portfolios 1 year from a year ago today, most of us would have not circled the number that we're currently looking at. And so we just got out of our investment committee a little, I would say, pleasantly surprised that numbers are sort of holding in where they are. An important Fed meeting tomorrow where we know that we are feeling inflation pressures build, and the expectation really that they're going to continue to build. And so the Fed obviously has to walk a bit of a tightrope in terms of what they signal to the market that they're going to do. So as we stand today, the expectation by the market is that the Fed will start to raise rates November of 22. So, and then of course, starting to ease out of the programs that they are in to buy assets that are supportive of keeping rates low and keeping the economy fueled with liquidity. We can also say for sure that the liquidity that they have injected has had what we all probably were aware would be unintended consequences. And a lot of people are referring to the many examples of speculation that are rampant throughout the different assets and different stocks that are followed and different things that are talked about in the news. As is our style, we largely avoid we're seeing massive fluctuations on a daily basis, 15-20% in certain battleground stocks. I refer to them, and I think our last video is witnessing a bar fight. Certainly my instinct is always to tiptoe away and toward the door and not be hit with any random flying objects. And that will continue to be our condition. I think if we're looking at, why we were staying in and long throughout the depths of, as bad as things got, it was because we're always aware that the narrative always looks forward and can change quickly. And so it gives us, and if we like what we own, it gives us confidence when things don't look as good, and gives us the equivalent amount of concern when things look a lot better. So for me now, I start to think about how things might look 3 to 6 months from now, and things might look like a massive deceleration. Right now, we're looking at airlines and cruise lines and hotels at pre-pandemic levels of prices, and the business that they're seeing is not anywhere near pre-pandemic levels and won't be for quite a while. So again, you won't see a lot of that stuff populating your portfolio because we don't want to be vulnerable to these, whipsaw movements. So we did add something today, which you'll see. And again, it's indicative of the mood that we're in, which is to stay in things that we think, are somewhat of a discount from where they were. We see a good path forward for them and strength, almost regardless of what the economy does. So that's kind of where we are. And so that, and I would say, uh, there have been some enhancements in the Black Diamond platform. Some of you use it, many of you don't. If you're interested in things like, you know, your performance and how the different strategies are performing, it's available there. There's continuous enhancements that are pushed onto that platform that we like and we find valuable. And to the extent that you do as well, that's great. And to the extent that you're comfortable not paying attention to it and catching up when we chat, then that's okay too. So I don't think there's much more to add for today. The next few weeks will be very interesting because it gets us right into April, which is the all important earnings month, right? Every quarter we get the report card. And so then we will hear our Q1 2021 results starting to come in, and the market will start to price in, all the different things that we're starting to see as there's some important shifts in in what's going on underneath the surface that we'll look forward to reporting on as they happen. So anyway, just wanted to update you. Haven't talked in 10 days or so, but I wanted to say hi. And here we go. We're already into the third week of March and almost done with Q1 2021, and on we go. So hope you're all well, and we'll look forward to catching up again soon. Thanks. Bye.